I would really encourage folks to really think hard about use your portfolio, and I ask people to really hear me on this frequently. Use your portfolio of alternative investments to design your income so that you can replace your W-2 income with income coming from stable assets that go up in value when the market gets afraid, scary, slows down, what have you. So so just paying attention to the type of asset class that you're making an allocation to is a best practice.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. I am also with Ted Greene at Spartan Investments, and poor Ted, he has agreed to have economic conversations with me on a semi-regular basis, so he's stuck. So we're gonna have ourselves an economic conversation today. I think there's so much going on, Ted. There's so much movement happening. The Fed paused, the Fed started again. What does that mean? You guys are deep in the storage unit, and you guys used to be deep in the residential space, but I'm still into the residential space. And I think there's a lot of conversations to be had as we just track what's the Fed doing and what are they gonna do? Because it makes a difference to every investor in every asset class. Every asset class has its particular picadillos. Every
Yeah.
region has its picadillos. So let's not be confused. We might talk
Yeah.
about national things, but regional is much more powerful and important in the end result. So Ted, you just were kind enough to do a write-up for my newsletter, which I so appreciated. And it starts with the fastest growing sector of the U.S. economy is the multifamily housing sector. The amount of new supply coming online in the next couple of years is staggering. Let's just start there.
Yeah. Just a little bit of background. Number one, I'm an old person. Old people have scar tissue. in in my former life on Wall Street, starting in 1991, when I walked into Merrill Lynch in downtown Seattle, I quickly started to learn who the economists were that I could rely on.
Yeah.
There's a gentleman that I've followed for over 30 years now. That gentleman's name is David Rosenberg. From my experience, now 30 plus years in financial services industry, David is the economist that is most right most of the time.
Okay.
By the way, fun fact: those are the ones you want to listen to. um, Case in point, in 2007, David made the comment, "What would happen?" And we were at the Four Seasons Hotel in downtown Seattle. He said, "What would happen if we all came back in 10 years and our homes were worth the same that they are today?" You could just feel the room. I forget what room we were in the Four Seasons, but you could just feel that, like, you gotta be kidding.
2008?
Well, no, this is 2007. So he was,
2007.
yeah, so he was a
Okay.
year early, but yeah, boy, did he
No,
call
no,
that one.
no. Yeah, go ahead.
Yeah. Yeah. So anyway, so he's been most right most of the time. By the way, another story he shared was he was in the room with government officials from China, and the Merrill people were pressing them on when are you going to depeg the yuan or the won. I'm not
Yeah.
sure how to pronounce the currency name. And the response was astounding. They said, if you were pressed to do something that you had no idea what would happen with your currency, would you do it? So anyway, you just over the decades you learn who to listen to. At least that's my experience. So I continue to subscribe to David's work. He's a very sharp thinker. You can find him on YouTube. He frequently puts out a short ditty. His team has done a lot of research on the supply of multifamily assets coming across the country.
Yeah.
As you mentioned a moment ago, housing and shelter is very localized. So I'm making a very broad statement here, and it should be synthesized from a local perspective because there are neighborhoods where there may not be much supply coming online. Anyway, with that being said, there is an astounding amount of product coming online that is under construction. How could there not be? Interest rates a couple of years ago, before 2022, interest rates were, for borrowing of funds, you could get no cap adjustable rate loans at 3%. Um, anyway, case being, there's a lot of new supply coming online. I think it's a increase of 17% year over year. It's been a week or two since I wrote that article, but it's about a 17% of total supply that's coming online, which is staggering. So in some markets, that may be more supply than the market can absorb.
Mhm.
In general, we've never seen this much supply coming online. That's another point that I was making in the article, that we've never seen this much supply coming online.
So 17% more of supply, which means physical development of units
Yep.
coming online. Now, I've heard 700,000 doors was the number I heard. I don't know if that's accurate or not, or they're talking about the same number.
Very plausible. I don't have I haven't quantified it, and it's not fresh in my mind. It's been a couple of
Okay.
weeks, but it's an astounding supply.
It's an astounding sum. Here's my question: the makeup of that. Yes, there's a regional effect, but there's also a niche effect. The makeup of it. I've heard, but we're just comparing data. We're just having an economic conversation, right? Is it that there's a predominant amount that's in luxury?
That makes my stomach hurt. Yeah, yeah. Um, Employment is a lagging indicator, and we are starting to see employment, number of hours worked. And by the way, let's just unpack that.
That was
The
going to be my
stock.
next topic, by the way. Is well, it was one of my one. I have two topics. One is inventory of multifamily, which is where we're starting, and the second is job participation. So yes,
Let's tie those two together, because
sure.
this is really interesting stuff. Monthly, from the Department of Labor, we hear about job growth, or the number of jobs being added. But that's the headline number. They don't tell us the number of jobs lost. They don't tell us what the average number of hours per work week was.
Hmm. Hmm.
If we incorporate jobs lost and average number of hours worked, for them, this is now late July. I think it was June. We actually lost 1.4%. I'm forgetful of where we're at for June, if the Department of Labor has put those statistics out yet. But we are starting to see a lagging indicator crest and start to roll over.
Okay.
The reason I think that's important is when the economy is on the come. 2001, we were coming out of COVID. People were starting to feel good. Stock market, it's up. Not as up as it is now, but stock market was up in
Hmm.
2021. So it's easy to feel really confident in that environment. And so if a tenant is going to reach from a class B to a class A, that's the environment they do it in. Yeah, think about this. March of 2020, we all should raise our hands if we bought stock. Now, my hand's not going up, because March of 2020, remember, that was COVID. That was scary. Like, things were
Right.
starting to lock down. Nobody's driving
Right.
around during the day. So, so during times of contraction, people don't reach. They don't go for luxury class A when the economy is slowing. You look at the yield curve. The yield curve is screaming recession right now. You look
Hmm.
at China. China is screaming recession. They're not buying stuff from the U.S. the way they used to. Manufacturing is down. Freight rates are down. Inflation, you strip out shelter, and inflation is barely positive.
Okay.
So, on a 3 month look back, it's actually negative. So yeah, it makes my palms sweat just a little bit if there's a lot of luxury supply coming online.
Yeah, and I've also heard that past that, that's these units, right? We each have our sources. Mine, I'm listening to Neil Bawa is the source that I
Hmm.
got my data from. Yours is Rosenberg. But past that, there isn't nearly as many units slated to come online
Hmm.
past the end of 2024.
It,
The
it,
development has jumped back down again,
yeah,
or dropped
uh,
again.
yeah. I think Niels and you hit the nail right on the head.
It's
Borrowing,
Neil. I'm
yeah.
just Neil's puppet. I'm just repeating Neil.
It, but I think you're right. Borrowing costs are elevated. It'll take a while for the market to absorb the supply that's coming online. we may lose some of those properties if we actually have a recession of substance and tenants, stay put, or maybe even move lower as opposed to moving higher by way of a property type.
So let's jump to that then, because you kind of covered my question about jobs and the participation rate. Like, well, actually, let's stay with jobs for a minute. So what I saw recently was I saw one statistic was 10 million, another one that was 9.8 million jobs, and the amount of participation we're getting, the amount of not participation, but the amount of workers that are actually looking is somewhere around 7 to 7.5. That's what
Mhm.
I have heard from James Wang, from Neil Bawa, from New York Times. So that is a gap. And that gap, as to borrow from James Wang, makes it sticky. The Fed
Hmm.
is up against a sticky situation. We had a lot of savings that people need to burn through. They have now, right? Use of credit cards has gone up, right? So people are now increasing their debt load instead of decreasing their savings, now increasing debt. We then have jobs. You can't lower wages if you have not enough bodies to do the jobs that are needed, right? So
Yep.
that is causing the Fed to have a sticky market. And then you add residential. We just talked about residential and the extra supply in residential, right? That to me adds a sticky market in the residential side. So let's talk about jobs for a minute. The Fed, I mean, you're saying you take housing out, you're seeing the inflation rate is down. That's what the Fed wants, right? But how's
That's,
the Fed going to deal with this sticky market? That's the
yeah.
question.
S- s- we've seen we've seen the Secretary of the Fed discuss the topic of being like Greenspan. So, in other words, when Greenspan broke the back of inflation,
Mm-hmm.
I think what the Fed is intent on doing is
Mm-hmm.
making sure that they have the bubble pricked by way of the inflationary pressure, certainly by way of real estate assets. So they're going to go without any question further than they need to go, because if you strip out shelter is 33% of the CPI. Energy is 8%. I'm going on memory here, but I think the sum total between shelter and energy, I think it's 40%. So if we strip those out and look and annualize the last 3 months data, we're less than 1%. I think we're at 0.9% X shelter, X energy. And it takes 18 months to feel the full effect of Fed rate increases.
Right.
And by the way, the stock, my next article for you is going to have to do with, in recessions past, where has the stock market peaked? Is it before the
Yes.
recession starts, or is it after the recession starts? Um, Point being as follows: the Fed has already slowed the economy so that X shelter, X energy, were barely positive CPI. Um, I, I just don't see a convincing reasons why the Fed should be going further the way it may go further this week. It seems
Okay.
like the futures market has priced in yet another rate increase by the Fed. um, I think that in time we're going to see the economy meaningfully slow, and I think we're going to have more than 2 quarters of back-to-back negative economic growth, which is the textbook definition of a recession.
Okay. And do you think to get there, because that is the Fed's agenda, right? To get there, do you think that an increase in July, which they indicated they would do, which has already been priced in, and an increase in, I think October was the second increase that they indicated?
I would doubt that they'll go in October, and the reason I say that is as follows: we're seeing meaningful weakness in the economy by way of various components to the conference board's LEI index. If we think back to, I think it was 1975, I could be off by a year or two, but in the mid 1970s, the Federal Reserve Board asked the Conference Board, which is a nonprofit organization, to create an index of 10 leading economic indicators. So not concurrent, not lagging indicators, but leading economic indicators. I'm going on memory. My memory is that of the 10 LEIs, one is positive, and that's the stock market, and it's based on a 12-month look back. So what I'm the point I'm driving at there is most of the LEIs are are showing negative growth as of lately. They're moving into a contractionary phase, which means if we layer on top of that the notion that it takes 18 months to feel the full effect of a Fed rate increase, and this is the end of July. The first Fed rate increase was April of 22, which is less than 18 months ago. So we've got a long way to go where the follow-on effects of those rate increases need to work their way into the pace of growth of the economy, which I think is likely to move lower. It's a scary deal. Yeah, it seems to me that the Fed is paying way too much attention to the stock market and is not paying near enough attention to what's actually happening with, just for example, manufacturing. Manufacturing is contracting. Um, so it's a worrisome topic to me.
Let me share something with you here because this is how I do things. Um, let's see. Okay, so this is the 10 components of it's the LEI, right?
Yep. So I
Okay, so
see
average.
seven there.
Yeah, that's seven. The other two are down. The other three are
Okay.
down here.
Okay. Yeah.
Yeah. But I just thought I'd bring up the list. And you, like you said, the S&P 500 stock index is only one. Building permits is another. Capital goods is another. Right, what you were talking about.
Hmm.
Um, Goods index, consumer goods, purchasing managers index, the PMI.
Hmm.
Right,
Manufacturing.
manufacturing itself.
Yeah. Yeah.
Right, number of applications for unemployment insurance.
Yeah.
Right. So when you look at that, when you look at those indicators, manufacturing, consumer goods, capital goods, I don't know where the PMI is. I haven't looked at that one recently.
Yeah. Purchasing managers index. I did
Right.
a post recently on them. It's showing contraction.
Right. The M2, right?
Contraction.
Monetary supply contraction, bond
Can we
markets.
can we
Go ahead.
hover on that one just for a minute?
Totally.
This is
Totally.
so
This is
interesting.
just, yeah, go ahead.
Yeah. So the month. This is July. I think it was either the month of May or the month of June that for the first time in the history of the United States of America, that's a statement. For the first time in our country's history, M2 was shrinking. M2 is a calculation of the velocity of money. And so we're going to go PhD level, full nerd here for just a moment. Um, we've heard about the Fed being in the market, buying um, mortgage-backed securities or adding liquidity to the economy. And this is pre 2023. So during COVID and in years prior, of course, to restart the economy after the Great Recession, all kinds of things were happening. So the Federal Reserve created what is called the repo market and expanded the repo market. And in essence, think of it this way, Christina. Let's say you own a $100 million office building, and you want to refinance your office building because rates are lower. Well, okay, so you go to your bank, maybe it's a small or mid cap regional bank, you refinance the loan, and then the bank takes your loan and sells it to the Federal Reserve as part of the repo market. And that it provides the bank with liquidity. Now they can go back into the market and provide, somebody else an office refinance loan on their office building. Well, now the Fed has said our balance sheet is too big. This is about 9 months ago, they determined their balance sheet is too big. They're going to start rolling off debt. Well, what does that mean? Here's an example. Somebody who 5 years ago had refinanced their office building, these office loans, they come due every 5 or 7 years. So the Fed in the repo market, now the Fed is not in there buying loans from banks. And so uh, office building, Mrs. Office Building owner or Mr. Office Building owner, when they go to refinance their commercial loan, they go to the bank, and the bank is saying two things. Number one, office building occupancy is way down. Number two, the Fed is not in the marketplace buying the loan that we give to you. So, so there's a decreased volume of loans coming through, and your credit quality better be top shelf because interest rates are up and occupancy needs to be up, which it's not in office. And so we've got some banks, as we saw with SVB, Silicon Valley Bank, and some of the others that had trouble a couple of months ago. Um, so we've seen, there's starting to be what, I think we first learned about this term back in 2010 or 2011. There's starting to be dislocation, which means the gears that usually fit together normally and keep the economy working, now things are kind of starting to get jammed up a little bit, and things are not moving the way they used to. So M2, back to where we started, there's fewer loans from banks being sold to the treasury, and in fact, we're rolling those assets off. So loans are totally slowing down, and M2 is shrinking for the first time in history. And a lot of this is predicated on the Fed not wanting to be in the market, supporting these asset values with cash to buy the loans. But now with the Fed's backing away, there's fewer buyers for these assets and the prices are coming down. It's a
It's a
challenge.
well, it is a challenge. It's to me, I think it's a bit ingenious slash fascinating. Some might say scary. Don't know what everybody has their opinion. That they both are capacity to increase rates
Yeah.
and decrease money. And you take both, and that becomes a much more powerful combo. I mean, I remember in 2000, I don't remember what year it was 2010 or 12 or something like that. Like the Fed has nothing left in the arsenal, right? But right
Yeah.
now, I would say these two together is actually quite powerful because you really do. We put a lot of money in, right? An artificial constraint called COVID, temporary. We call
Yeah.
it temporary. A temporary
Yeah.
constraint called COVID because I don't want to get into artificial or not. I want to get into.
Yeah.
We had a temporary constraint. I don't want to get down that conversation. This is not politics. The temporary constraint called COVID, right? And then we had this huge influx of money, right?
Yeah.
So we have all this money coming into the system. M2 shoots up by 40%, right? And then then we're like, oh, well, COVID wasn't nearly as devastating as they were projecting, as the International Monetary Fund, the IMF projected, wasn't nearly as devastating. Um, Economically, I'm not going to go into further conversations on that, but we now had all this money in the system. We had
Yeah.
probably, I would say, more money in the system than what COVID itself pulled out of the system.
And unwinding this will lead to dislocation at the end
Right,
of the day. Yeah. And so,
right.
so for
Exactly.
me, mid 50s, I don't have a 30-year or a 25-year runway to retirement. And I
Mm,
want to make sure that, I really don't want to get my hand scratched, let alone cut off,
right.
by way of being in a bad market and not being able to get out. So, so for investors who are trying to place risk assets, I would really encourage folks to really think hard about use your portfolio. And I ask people to really hear me on this frequently. Use your portfolio of alternative investments to design your income so that you can replace your W 2 income with income coming from stable assets that go up in value when the market gets afraid, scary, slows down, what have you. So, so just paying attention to the type of asset class that you're making an allocation to is a best practice.
Storage units is one of those, straight up the pipeline the whole
It
time.
it may be one.
Every
Yep.
time.
Yep.
It's
Yep.
one of the things that you guys specialize in is and storage units continue to do well even in non-recessionary times, but the usage of them peaks as people move, as businesses close, right?
W-
So
w- Yeah, we saw during COVID, we saw a 12% increase in lease rates across the board as an industry. So with no regard to climate controlled or non-climate controlled, no regard to a Class A facility versus a Class B facility, just across the board, it was a 12%. As people deal with life events and transitions, your business fails and needs to close, you need to downsize, you need to move, you change jobs, you're laid off, what have you. Um, it it has a tendency to have life events drive occupancy and storage.
Right. And I was about to say, because you just echoed and laid the groundwork for what I was about to say, is we just went from a peak of storage use to, if we do have, but if we have job loss, we have slowing in economic growth, which is already happening. We have the subsequent job loss, which is what I believe the Fed is pushing for. That is also a peak in storage units. So all these people that moved, whether they moved someplace they're happy to or not, as they lose the capacity to keep what they decided to move into, then we've got another peak in storage units. So storage units should stay high, is high and should stay high as far as its value and its usage and its return.
There is a strong argument for the notion that as people do deal with life transitions, moving, closing businesses, what have you, lease rates could go to a new all-time high just because the volume, the
Mhm.
percentage of people dealing with the life transition. It's really interesting in storage. I kind of think of it as I don't care money. $200 a month,
Yeah,
I don't care.
I don't
If I
care.
have to,
Yeah,
yeah,
I've got storage units. I don't care.
s- but over
Right.
10 years, we all care. For 6 or 9 months, nobody cares.
Yeah, and I don't know all the habits of storage unit usage, but I do know, and I suspect there's a number out there that says how many people get a storage unit thinking it's 6 months,
Oh, yeah. So last
and then
week
they keep it. Yeah, go ahead.
yeah. Well, so last week, Spartan had what we call Spirit Week. So everybody congregated in Golden, Colorado. We worked in the morning, and we go do an activity as employees of Spartan in the afternoon. And
Right.
I had a chance to talk with Mike, who's part of the asset management team. And our average tenancy so I think we're at 40% business owners. And so for the individual tenant as well as the business owner lumped together, our average stay is over 3 years,
Mm,
which business owners having a storage unit for 10 years, I get that. You lump in the folks that are typically thought of as transitory,
mhm.
and to have the average be over 3 years goes to
Still,
your point. How
good.
many people that started 6 months? And yeah, so
Ended up staying.
it's
Yeah,
it's sticky.
yeah. After
So,
my mom passed, typical life,
I'm
right?
sorry.
Oh,
Yeah.
it's okay. It was 2014, and I think in the end result, she felt it was good timing for her. So we can honor that.
We're going to take that and have, yeah, I'm glad it's a horrible situation. Yeah.
It's okay. Didn't mean to stumble into that, but
Well, it's
appreciate
so
your time.
interesting that
Go ahead.
I'm about to deal with a similar chapter. We'd better move on because I'll just start to cry on on your
Aw,
podcast.
okay.
Yeah,
Oh,
life
we
can
love
be
we
hard.
love we love our mamas.
There, with you,
Okay,
boy. Yeah, you're not kidding.
we love our
So,
mamas. So my mom was a very tough cookie, but in the end result, if I say what I'm going to say, you're going to definitely start crying. Okay,
yeah.
I'm moving on. I'm moving on. All right, we can talk
Thank
about
you.
your mama another time.
Yeah.
But the point is that I kept that storage unit. I thought, oh, I'll sort it all out in a year.
Yeah.
This is let's see, 8 years later.
Yeah.
8 years later, I'm like, yeah, no, I'm not going to sort it out. I'm going to leave it just the way it is. I'm good with that.
Yeah.
That's
Yeah.
okay.
Life is, who's got free time? Life is busy. Nobody's got free time. It's hard
Right.
to clean out a storage
And I
unit.
don't have free time by design. I'm just saying. It's not like
Hmm.
I'm not complaining. I don't have free time by design.
Yeah.
So okay, so let's get back into here's the two questions that I feel like I want to really nail. One is, what do you think the Fed's going to do moving forward? Right?
Hmm.
We've talked about indicators. We talked about what they're watching. We've talked about that maybe the Fed is paying too much attention to price of housing because it is such a big part, right? At 33%. What is Fed going to do? And then the second question is, and what's that going to mean to us as investors? I'm in residential. You guys are in storage units. We already know office is on its own trajectory, so we don't have to discuss that.
Yeah.
But let's at least talk residential and storage.
Yeah. I think the Fed will pause in July. I'm totally prepared to be dead wrong on that. They may go later this week, but I think that the Fed will pause. And the reason I say that is, why would they pause last month and not pause again this month? And it's all part of the jawboning that the Fed has done to to get the economy to slow, and I think they've overdone it already, because again, we have not felt the full effect of the work that they've done, and we're
That's right.
seeing meaningful slowing in the leading economic indicators.
Yeah.
As far as what it means, if and do I have that correct? That the second part to the question is, what does it mean to us as
What does
investors?
it mean to us as investors? Whether crypto, gold, residential, storage. We can talk warehouse as well. Um, Mobile home. How
Yeah,
many of those you want to hit on?
yeah. I'll pick on the one that wasn't on your short list just now, which is the stock market, and maybe I can pick on that one first.
Oh yeah,
Um,
that's right. Stocks.
yeah, yeah,
We've gone up by 20%. I just ran the S&P 500 graph
yeah,
yesterday, just as a fluke. I'm like, "Oh, okay, let's just look at it. And it's
yeah,
gone up by 20% since the beginning of the year.
yeah. Um,
Okay, go ahead.
yeah.
Stocks.
And what's interesting is, if we look at the patterns of the stock market leading up to a recession and what happens, generally speaking, I'm going to throw out a statistic here. Generally speaking, the trailing 12 before a recession starts is between 14 and 18% annual rate of return prior to a recession taking shape. And of course, you don't know a recession is happening until a couple of months into it.
That's right. Back end.
Um, yeah. So it is very normal to have the pace of acceleration in the stock market accelerating upwards before you have an economic. It would be abnormal to not have an acceleration upward in stock prices. Um, uh, if we look at things on an absolute basis, 1982, at the end of a very tough, bad stock market, from 1968 to 1982, 14 years of sideways movement where the stock market, there was a period of time in 1982 the stock market was at the same price that it was, and I'm speaking of the Dow Jones, same price that it was in 1968. So 14 years, nothing other than getting some dividends. The PE ratio in the stock market was less than 7. So if any of us were to Google PE ratio stock market Dow Jones 1982, it'd be I think it was 6.72 or 6.75. Point being as follows: currently on forward earnings, we're almost 19 times earnings.
Hmm.
And so when we look at forward earnings, that's a smaller PE ratio than past earnings, where the PE ratio would be higher, because if earnings are $20 in 2021, $22 in 2022, and $24 in 2023, forward-looking PE ratio is smaller
Because it keeps
backward.
getting bigger. It's
Exactly.
it
Exactly.
gets bigger, which makes the division smaller, makes the end result of the division smaller.
That's exactly right. So if we're at 19 times earnings on forward-looking earnings compared to where things have been at the end of the bear market, that being a PE ratio of 7, what that says to me, and by the way, the high teens, that's the same PE ratio forward earnings that we were at in 2007, and where we were at the dot-com bubble in the year 2000.
Yeah.
I think actually it was 2001. No, it was March of 2000 that the stock market peaked.
It was
So
2000. Yeah. It was
yeah.
2000.
So by way of investor psychology,
I remember it vividly. Go ahead.
yeah, yeah. Well, so by way of investor psychology, there's plenty of room for investor psychology to turn more bearish or turn more negative.
Mhm.
You don't want to, you never want to find yourself in a situation where you don't have dry powder. Another way to say this is, I think a lot of folks would be well served to make that reallocation of where my assets are invested, and have I designed a stream of income from my investments that replaces my W-2 income. Certainly, the older we get, the more we want to make an adjustment to what our risk assets are, so that they match our preference or aversion for
Mhm.
risk.
So therefore, the concept is we're at a number right before what would generally be a turn in the market in the stocks. So now is a good time to consider reallocation intentionally out of stocks.
I, um, I would leave that to the investment professional to make that advice, but but,
Okay,
but
I'm willing to make that advice. Maybe I shouldn't be willing to make that advice, but I'm willing. I'm willing
yeah,
to make the advice that it's if you are an investor and you're interested in timing, which is a risk by itself, being an investor that is interested in timing is a risky approach, right? But I think you're suggesting that we have indicators that the stock market might be at a high.
oh man, yeah, from my perspective,
Is that fair?
absolutely no question
Okay,
about
good.
it. And in a recession, what happens? The Fed lowers interest rates.
That's right.
Accordingly, what happens to bond values and all asset values where there's strong cash flow coming off the asset? Christina, you raised your hand. Those assets, every time there's challenge in the economy, every time they go up in value. Why would
Mhm.
they not? The Fed's going to be lowering rates if the scenario plays out. So,
And, and I don't see how it couldn't. I'm just saying. I mean, like this whole conversation. I keep trying to my agenda, right? Like you have an agenda about people moving their assets into predictable cash streams, especially as they get older, so that they
yeah,
can relax and
yeah,
understand that they don't need to be on the roller coaster or the
yeah,
pendulum. I don't know whatever this movement is, this up and down movement, that is constantly the case in the economy and
yeah,
in stocks, in
yeah.
investment classes, because real estate sensitive. Real estate moves too. Cash flow, having cash flow, so you don't have to be sensitive to the changes of the values of the assets that you're holding. Um,
Or make an adjustment, or sell. You don't want to have it to be selling your stocks because you're so worried that things might continue to go lower.
right, right. You don't want to be forced into playing a timing game
Yeah,
if that's not and as we get older and as I get older, I have less interest in trying to force an appreciation or force timing. um I can't even remember what my original point was that I was going to as I repeated your point, but that's okay.
so, well, so maybe I could just regurgitate what I heard you say. A variety of private investment asset classes. So you're familiar and you're licensed to provide advice by way of investors who are pursuing private investments. So, so for investors who are looking for stable streams of cash flow, you're a great resource as far as, well, okay, Christina, here's my net worth. What percentage should I be putting into an investment if I want to take a little bit out of my 401k that I've rolled into my IRA? You know, position sizing, staggering of maturities,
Mhm.
diversity of industry and asset class that your investors are placing capital into. I mean, those are really deep and important questions that investors really ought to be kicking around.
They really should be, and a lot of them don't, unless they have an advisor, unless they work with an advisor. But so Fed, so you think that the Fed is going to pause in July?
I
Do
do.
you, and because you think that we've already seen pain in the industry, they
Hmm.
know just as we know that it takes 12 months, 12 to 18 months in order to feel the effects of the Titanic they're trying to turn, and
Hmm.
they're not going to be quick to pull the trigger. They paused in
Yeah.
June. You think they're going to pause in July so they can watch the unfolding?
And by the way, admittedly, the futures pricing in the options market says that the Fed is going to raise rates. So I'm being a bit of a
Yeah,
contrarian.
you're a minor opinion in the market as far
I
as they're
am.
concerned. Yeah.
Yeah, I am. Yeah.
Okay.
But
I am not of that opinion, by the way. I do think they're going to raise rates.
yeah,
I think the Fed is. I'm not sure that they're interested in overshooting, but I think that given the stickiness I'm seeing in both the employment market and in the real estate market, right? Prices of rents, 33% of CPI. I think they're gonna go for it. I think
yeah,
they're gonna increase in July and I think they're gonna do it again in October. And
yeah,
now every time they increase, I'm holding my breath. I'm like, okay, well, now add to that 12 and 18 months time period a little longer.
yeah.
right? So
Yeah.
you measure it 12 to 18 months from the first increase,
Yes.
not from the last increase.
Well, the full effect of the last increase won't be felt in the economy completely until 18 months later.
Until the last increase. Exactly.
Yeah.
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 Okay. So I think that answer. So, okay, what does that mean? So I know we're at the end of our time. So then real quickly, what do you think that means for residential? Just give me bottom line.
Yeah. I don't think much. I think that the residential market, there's just not much volume, and it won't be long, I think, until interest rates are moving lower. Now, the risk premium may be moving higher, but I don't think there's going to be much volume coming through on the residential side. And
Hmm.
so there's not much movement lower in price due to a slowing economy. So the residential market, there's a lot of good reason to have conviction it's going to hold up just fine.
Yeah, it's stuck. Residential stuck for a
Yeah,
couple of different reasons. All right,
yeah.
storage, because that's your particular area.
Um, I think there is very good reason to consider it as one of several asset classes that investors invest into. I'm always of the opinion that the wisdom of diversity supersedes everything. So keep it on your short list, count on it as durable and stable income. Don't bet the farm on any asset
And
class.
any asset class.
Yeah.
Mobile home.
In the right market, I love it. Because to me, it's the opposite of luxury, and
Mhm.
specifically workforce housing. If it's a non-cyclical um, asset class that workforce housing is served by, I mean, the lowest common denominator seems to me to be workforce housing mobile home park. So I love it.
Okay, office. We'll just throw it in there.
Yeah, it makes me want to throw up. Not a chance.
I don't think office has got much of a chance these days. Ted, thank you
No.
so very much. I'm going to bring this to a close. Thank you for listening once again for the Christina Suter Real Estate Breakthrough Show. You can see me at christinasuter.com. You can find Ted over at Ted Greene. No, sorry, at Spartan Investments. And what's the name of where you post, Ted?
So my favorite is LinkedIn, and thank you, Christina, for the opportunity. I know you've got a massive following and a large audience, and it's an honor.
Ted, good to have you. Don't go away, guys. See you next time.